In order to get a general understanding about the medical malpractice insurance industry, what you need to do is you first need to understand how an income statement works and is different in the insurance field compared to a non-insurance field company. Now here's an example of a typical income statement and what elements you'll find in that income statement. In this example, I used a widget company. You'll first see that we have revenues, and that's very simple for people to understand. That's when a widget company sells widgets. They get money for those widgets. Those are called your revenues. The second element is called your expenses. Very simple to understand as well. The costs of making those widgets, payroll, rent, etc., are your expenses. When you take your revenues, you subtract your expenses, you get your profits or your net income. Very simple to understand. Now let's compare that to an insurance company. In an insurance company, we have what's called statutory, because there are laws that require us to report these income statements differently. And here's an illustration of a typical statutory income statement in the insurance field. You'll have premiums, which are like revenues. It's how much money we as insurance carriers actually collect. But the second element that you've never probably seen before is called incurred losses. They're also known as loss reserves. When we get claims, when we find out that a doctor is going to be sued for a certain incident, we actually have to reserve money to pay for that claim into the future, even though we haven't paid it out today. We have to record it on our income statement this year. And then we have our third component. Much like a typical widget company, we have expenses, rent, computers, paper, etc. When you take your premiums and you subtract your incurred losses and your expenses, as a result, you get your profit or net income. Now, let's see what that looks like in actual numbers. Now, here is a typical illustration of a statutory income statement from an insurance company in the medical malpractice insurance industry. I used an example as $100 so you can understand percentages. The premiums collected by this insurance company in the medical malpractice field is $100. Now, what we would subtract from that is what we reserve for those losses in the year, even though we haven't paid them yet. Typically, in a medical malpractice insurance industry, that will equate to 80% of the premiums, or $80 in this case. Then we would also subtract your expenses, which are generally between $20 and $30, and you get a result of what's called your underwriting income or loss. And in this particular scenario, that would be a loss of $10. Now, because you'd sit there and say, most insurance companies can't possibly be in business to lose money, we forgot that one component that comes in after underwriting income or loss that you need to add to this income statement, and that is investment income. Now, the investment income comes from the fact that our premiums that we collect are actually sitting in our bank accounts for years and years before we pay claims. That investment income typically is going to be 20% of what the premiums are for the year. As a result, you actually result in a net income or profit of $10, or 10% of what you collect each year. Now, what would the impact be if you were an insurance carrier and you wanted or had a desire or need to state that you were profitable in this calendar year? It's very simple, because the largest component in an income statement is your loss reserves. Meaning, let's look at this illustration of the income statement of what impact would happen if I chose to reserve $50 as opposed to $80 for my loss reserves for my claims. You can see my premiums are still $100. I'll subtract $50 as opposed to $80, and I'll subtract $30 for my expenses. We will see a $20 underwriting income as opposed to a $10 underwriting loss. Add to that your investment income of $20, which stays constant, and here you see the net income rises from $10 all the way to $40. Now that you have an understanding of what an income statement looks like, let's go into the inherent pitfalls of the medical malpractice insurance industry. And the first one is that short-term profitability can be achieved by merely under-reserving or aggressive reserving. Now, as you can see from the income statement that we just learned about in the insurance field, if I were an executive of a medical malpractice insurance carrier and I was publicly traded and I wanted my stock to go up, or if I was looking for someone to acquire me, I want to say that I'm profitable for this year. How can I achieve that? Well, it's relatively simple from the last slides on what an income statement looks like. I can simply under-reserve for claims, meaning that if a catastrophic baby case is reported to us as a med-mal carrier, we may only reserve $800,000 for the claim, although reasonable conservative estimates may have put that claim at $1 million. By simply under-reserving that for $200,000, the net result would be a $200,000 positive impact to my income statement. The number 2 inherent pitfall with our industry is that it's a long-tailed insurance line. And what does that mean? It means that in the medical malpractice field, we have the longest average time from when a claim is actually filed to when we actually pay that loss. Therefore, when you want to verify and determine whether or not I reserved properly or made mistakes in my reserving, it takes much longer as a regulator to determine my inaccuracy than other lines of insurance like auto insurance or workers' compensation for that matter. Now, how can you tell if the sky is falling? That's very simple if you can do your own tests. Before we get into the tests, let's talk about what you'll need in order to prepare for those tests. The first thing you'll need to do is contact the State Department of Banking and Insurance. It's a very simple number to acquire from your state. The second thing you'll do is when you contact them, you'll ask for a copy to be sent to the most recent annual statement for your particular insurance carrier that you're testing. They'll charge you only minimal copying fees. Or alternatively, you can go to your agent or broker and ask them to put in writing what the financial data is for these tests so you can test your insurance carrier. Now, the first term that you'll have to understand is the word surplus. It's a very important term in the insurance field. Now, what is surplus? Surplus is the excess capital, or cash, an insurance company maintains that has no allocated use. The surplus literally is maintained only to act as a cushion in case the premiums that are collected for the year are not adequate to pay for the losses. We parallel this to somebody's savings account. You don't necessarily want to dip into your savings account, but if an emergency occurs, you can go into that savings account and use that cash. Now note, the dollar amount of your surplus for an insurance carrier itself should also be only put into perspective in ratio to other components in the financial statement. And we'll get to that later, because this will really indicate the ability for a company to pay its claims if their reserves are off slightly into the future. Now, test number 1, your loss reserves to your policyholder's surplus ratio. Although this sounds very complex, it's very simple in understanding. This is the amount of extra capital, similar to the savings account, which is available in ratio to how much money is set aside right now for existing claims. Essentially, it's a measure of a company's financial ability to pay for claims if their reserves are inadequate or inaccurate. Now, here's the best chart I can provide for you to understand. The loss reserves to surplus ratio as an industry will generally fall below 3.5 to 1. Now, what this is testing, once again, is the company's ability to withstand adverse development. Adverse meaning bad development of their reserves. Now, here's a glimpse of the 2007 year-end financial statements of the ratios of loss reserves to policyholder surplus for all the admitted carriers that write insurance in the state of New Jersey. As you can see, they may vary drastically by insurance carrier. And that's why it is very important, along with other tests, to test your carrier to see if there's any indication of financial deterioration.